The bull case. 1. The Galena Turnaround. The first pillar of the bull case for America's gold and silver is rooted in the successful execution of the Galena Turnaround project at its flagship complex in Idaho's Silver Valley. For years, the Galena mine, one of the oldest and deepest silver producers in the United States, suffered from antiquated infrastructure that severely limited its hoisting capacity and development speed. The company's strategic decision to prioritize infrastructure recapitalization began to bear fruit in 2025, marked by the completion of several critical projects designed to debottleneck the operation and scale production. Central to this revitalization is the comprehensive upgrade of the No. 3 shaft. By the end of 2025, the company had completed Phase 1 of this project, which involved the installation of new hoisting motors and redundant egress systems. Phase 2 remains on track for completion in the second quarter of 2026, which is projected to increase total hoisting capacity to approximately 105 short tons per hour. When viewed against the 40 tons per shift capacity recorded at the start of the turnaround in 2024, this represents a 160% improvement in mechanical throughput. The implications of this capacity increase extend beyond mere volume. It allows the mine to remove waste rock at a significantly higher rate, thereby accelerating the development of new high-grade mining fronts that were previously inaccessible due to logistical constraints. Parallel to these shaft upgrades, the company has successfully transitioned its mining methodology from labor-intensive narrow-vein conventional methods to mechanized long-hole stoping. In 2024, the operation utilized 0 long-hole stoping panels. However, by the conclusion of 2025, between 7 and 9 panels were being extracted using this method. This shift has triggered a dramatic increase in productivity, with remote mucking operations now moving approximately 200 tons per shift, a 300% improvement over the 50 tons achieved through conventional mucking in 2024. The introduction of a new Alamac ventilation raise and the modernization of the underground fleet, including new 20-ton haul trucks and high-capacity loaders, have further optimized the ore flow from the 5,500 level to the surface.
Safety milestones have also played a crucial role in the bull case. In March 2026, the Galena Complex team achieved a significant milestone of 1 full year and over 500,000 work hours without a single lost-time accident. This operational stability is a prerequisite for the aggressive growth guided for 2026, where the company expects consolidated silver production to reach between 3.2 and 3.6 million ounces, representing an approximate 30% increase over the 2.65 million ounces produced in 2025. Resource expansion and strategic synergies via the Crescent acquisition. The second pillar of the bull case involves the unprecedented expansion of the company's mineral resource base, driven by both exploration success and strategic acquisitions. America's Gold and Silver entered 2026 following its most successful exploration campaign to date, which identified multiple high-grade veins that have fundamentally altered the long-term potential of the Galena complex.
The discovery of the 149 and 034 vein complexes has provided the most compelling geological evidence for resource growth. The 149 vein, in particular, returned record-breaking intercepts, including 24,913 grams per ton silver and 16.9% copper over a 0.2-meter interval. While these widths are narrow, the extreme grade profile suggests the presence of high-value sweet spots within the tetrahedral ore bodies that can be exploited using modern mechanized mining. Furthermore, the 034 vein has been expanded into a major mining zone, with intercepts such as 4,458 grams per ton silver and 3.34% copper over 0.5 meters. As a result of these successes, the Galena complex saw a 19% year-over-year increase in measured and indicated (M&I) silver resources, reaching 87.9 million ounces at an average grade of 500.9 grams per ton. Complementing this organic growth was the strategic acquisition of the Crescent silver mine in December 2025. Located just 9 miles from Galena, the Crescent mine is a fully permitted, past-producing asset that adds a historical M&I resource of 3.8 million ounces at 654 grams per ton. The logic behind this acquisition is centered on infrastructure synergy. By integrating Crescent into the Galena operational hub, America's Gold and Silver can utilize its newly upgraded hoisting and processing capacity to treat high-grade ore from multiple mine portals, effectively doubling its resource footprint in the Silver Valley while minimizing additional capital overhead.
To capitalize on this expanded resource, the company has announced its largest ever exploration program for 2026, with 64,000 meters of drilling planned company-wide. This program will focus on converting high-grade inferred resources into the proven and probable category and testing deep extensions of the newly discovered 520 vein at the core mine, which has already returned grades exceeding 600 grams per ton silver. The aggressive nature of this program reflects management's confidence in the geological continuity of the Silver Valley's vein systems at depth. 3. Critical minerals diversification and the Mexican production record. The third pillar of the bull case is the company's strategic pivot toward critical minerals and the continued operational excellence of its Mexican assets. America's Gold and Silver is no longer a pure-play silver miner. It has successfully transitioned into a producer of copper and antimony, minerals that are increasingly viewed as strategic assets by the United States government. In February 2026, the company signed a landmark joint venture, JV, with United States Antimony Corporation, UAMY, to construct and operate a new antimony processing facility in Idaho. Americas will own 51% of the JV, which aims to maximize the value of the 561,000 pounds of antimony already produced as a byproduct at Galena in 2025. By establishing a mine-to-finished antimony solution, the company can bypass the discounts traditionally applied to its polymetallic concentrates and capture the full downstream value of a mineral that is currently subject to a $248 million defense contract held by its partner, UAMY. This diversification provides a unique critical minerals kicker that insulates the company's revenue stream from fluctuations in the silver price alone. Simultaneously, the Cosala operations in Mexico delivered a record-shattering performance in 2025, producing 1.2 million ounces of silver, a 44% increase over the previous year. This record was driven by the successful integration of the EC120 zone, which hosts predominantly higher-grade silver and copper compared to the aging San Rafael mine. Commercial production was officially declared at EC120 on January 1, 2026, providing a stable foundation for Mexican output throughout the 2026 fiscal year. Furthermore, the discovery of the El Alacrán zone, located just 600 meters from existing infrastructure, suggests that the Cosala land package remains underexplored, with the potential to add significant mine life as the company ramps up regional drilling. Market recognition of these developments culminated in the company's inclusion in the GDXJ Junior Gold Miners Index and the Solotev Global Silver Miners Index, SIL, in March 2026. This index inclusion is expected to drive institutional liquidity and provide a valuation floor, as the company is currently trading at approximately 0.60x PNAV, a sharp discount to its peer group average of 1.10x. The bear case. The first pillar. The AISC paradox, high cost structure and margin compression. The first pillar of the bear case for America's Gold and Silver begins with a sober assessment of its cost structure. Despite the significant increase in production and revenue, the company's all-in sustaining cost, AISC, remains among the highest in the silver mining industry, creating a thin margin of safety. In 2025, the company reported a consolidated AISC of $32.95 per ounce of silver produced. While silver prices saw a historic breakout in 2025, briefly surging past $55 per ounce and averaging over $39 realized for the company, the high cost of extraction means that USAS is not yet generating the free cash flow typically expected from a mid-tier producer during a commodity bull market. The company's 2026 guidance offers little immediate relief, projecting an AISC range of $30 to $35 per ounce sold. The high AISC at USAS is driven by several structural factors. Deep underground mining at Galena is inherently expensive, requiring constant investment in ventilation, pumping, and ground support. Additionally, the transition to mechanized mining, while improving productivity, has coincided with a period of high inflation in labor and energy costs, as well as a decrease in byproduct credits from reduced zinc and lead production. In 2025, cash costs per ounce at Galena rose to $28.04, a 21% increase from the previous year, reflecting these headwinds. If silver prices were to retreat from their 2025 highs, America's Gold and Silver would be one of the first producers to face margin compression, making the stock a high-risk gamble on sustained commodity price strength. 2. Capital dependency and the cycle of shareholder dilution. The second pillar of the bear case is the company's heavy reliance on equity financing to fund its turnaround and the resulting massive dilution of its shareholder base. Since 2024, the company has repeatedly returned to the capital markets to secure the funds necessary for shaft upgrades and acquisitions.
In December 2025, the company closed a heavily oversubscribed $132.25 million bought deal private placement financing. While this injection of capital strengthened the balance sheet, ending the year with $129.8 million in cash, it came at the cost of a significantly expanded share count. As of December 31, 2025, the company reported 320,418,782 common shares outstanding, a figure that continues to rise as warrants and options are exercised. Furthermore, a filing in March 2026 reported the share count had already climbed to 322,886,429. Beyond equity, the company has taken on substantial debt, including a $100 million senior secured term loan facility with the SAF Group, of which $50 million was drawn by the end of 2025. This debt carries interest obligations and restrictive covenants that further limit the company's financial flexibility. For the 2026 fiscal year, the company plans to spend between $90 and $120 million on capital expenditures, with the company using $3.95 million of cash in operating activities in 2025. The sustainability of this spending remains entirely dependent on either the continued support of the equity markets or a dramatic turnaround in operational cash flow that has yet to materialize. 3. Internal control weaknesses and governance risks. A significant and often overlooked bear risk is the company's recent disclosure regarding the effectiveness of its internal controls. In its 40F annual report filed for the period ended December 31, 2025, management concluded that the company's internal control over financial reporting, ICFR, was not effective due to material weaknesses in information technology general controls, ITGCs, and certain process-level controls. These weaknesses include deficiencies in user access governance, IT operations, change management, and financial reporting for complex areas such as income taxes and contract liabilities. Management has attributed these failures to a lack of personnel with the necessary accounting knowledge and experience, as well as the rapid business transformation and limited financial resources encountered during 2025. While the company has implemented a remediation plan that involves hiring experienced personnel and enhancing IT monitoring, the existence of such fundamental weaknesses is a major red flag for institutional investors. It suggests that the company's administrative and governance framework is struggling to keep pace with its rapid operational expansion, increasing the risk of future financial misstatements or operational disruptions. This governance risk is exacerbated by the company's historical volatility in shareholder concentration. While Eric Sprott remains a significant backer, his affiliated entities recently sold 5 million shares in March 2026. Such selling by a core institutional supporter, even if for rebalancing purposes, can create negative sentiment and downward pressure on the stock price during periods of market uncertainty. 4. Historical technical failures and jurisdictional hazards. The final bear pillar concerns the company's history of technical setbacks and the increasingly hostile regulatory environment in Mexico. The most prominent technical failure is the Relief Canyon mine in Nevada, which was acquired in 2019 and targeted for commercial production in 2020. Following a series of teething pains, the operation was suspended in August 2021 due to metallurgical challenges, specifically the presence of unexpected carbonaceous material that poisoned the leach pads and severely inhibited gold recovery. The Relief Canyon failure resulted in an impairment charge of $78.6 million in 2021 and an additional $6.0 million charge in late 2023 when leaching operations were finally ceased. Today, the asset remains on care and maintenance, with ongoing studies failing to identify a cost-effective path to resumption. This historical precedent demonstrates that the company's technical modeling is not infallible and that geological surprises can lead to catastrophic asset write-downs. Jurisdictionally, Mexico remains a major source of risk. The 2023 federal mining law reform significantly increased the regulatory burden on silver miners. The term of concessions has been reduced from 50 to 30 years, and new laws mandate that 5% of mining profits be paid to affected local communities. Furthermore, the Mexican government recovered over 1,200 concessions in early 2026 for non-compliance, signaling a much tighter enforcement regime. America's Gold and Silver also has a history of labor unrest in Mexico, including a 19-month illegal blockade at the Casala operations that only ended after extensive government intervention. The combination of political instability, organized crime influence, and stricter environmental reporting creates a regulatory moat that could easily swallow the projected gains from the EC-120 project. In Idaho, the company faces environmental litigation regarding water pollution at the Galena complex. The mine has been cited for hundreds of violations related to arsenic and lead wastewater limits, leading to a civil complaint at the Idaho Department of Environmental Quality. While a settlement was reached in 2023, the mine is under a strict timetable to upgrade its water treatment facilities by 2031. These ongoing ESG challenges add to the sustaining capital requirements and create potential legal liabilities that are rarely fully priced into the stock. Conclusion. The investment case for America's Gold and Silver Corporation is defined by a bimodal outcome. On one hand, the company has successfully executed a transformational turnaround of its core assets during a generational bull market for silver. The Galena infrastructure upgrades, the EC-120 ramp-up in Mexico, and the strategic antimony joint venture have collectively positioned the company to achieve 30% production growth in 2026. If silver prices remain elevated and the company successfully completes the number 3 shaft upgrade in Q2 2026, the current valuation of 0.60x P over NAV represents a massive opportunity for a valuation re-rating. On the other hand, the company's high AISC, historical technical failures at Relief Canyon, and material weaknesses in internal controls cannot be ignored. The company is currently a marginal producer that is extremely sensitive to commodity price volatility and requires constant capital injections to survive. The massive share dilution over the past 2 years has significantly capped the per-share upside for existing investors, even as consolidated production reaches record levels.